Hi guys, welcome back to our channel, The Joyful Investors. Many of you have been very curious about whether dollar cost averaging works as an investing strategy. So in today's video, I'm going to share with you more about dollar cost averaging and why I personally do not use it. Dollar cost averaging is the strategy in which you invest the money by putting in a fixed amount of money over fixed regular intervals of time. You may have heard of this term regular savings plan. Though it is termed as a savings plan, it is actually an investment plan that is put up by various banks to offer people a disciplined means of investing the money by putting in fixed amount of money over regular intervals of time. So this regular savings plan is actually built upon the concept of dollar cost averaging to help to hedge against market volatility. Let me show you more about dollar cost averaging through this example.
Let's say you have set aside a sum of $400 for an investment budget. The current market price of stock A is $100. If you have adopted the lump sum investing strategy, you would then invest a single sum of $400 to purchase 4 units of stock A in the first month. However, if you have adopted the dollar cost averaging approach to put in fixed amount of money every month to buy stock A, you could have purchased 1 unit of stock A at $100 in the first month, 1.25 units at $80 in the second month, 1.11 units at $90 in the third month, and 0.91 units at $110 in the fourth month. Comparing both strategies, we will realize that the lump sum investing allows you to purchase 4 units of stock A at an average cost of $100 per unit. On the other hand, the dollar cost averaging approach allows you to purchase 4.27 units of stock A at an average cost of $94 per unit. You see, dollar cost averaging in this example seems to allow you to reduce the average cost of investing in a particular security, thereby improving your returns.
There is in fact a flaw in the previous example. Very often, people always show the perfect scenario in which dollar cost averaging works out to be beneficial for you. And that is when the share prices are decreasing. But what happens if the share prices are now increasing and rallying up on an uptrend?
Let us look at this example here. If prices of stock B increased every month to $120 by the fourth month, you can only purchase 3.69 units of stock B at an average cost of $108 using DCA. Hence, you are worse off than doing the investment through the lump sum strategy.
This is why even though the dollar cost averaging strategy encourages easy and disciplined investment plans, it may not be the best strategy that brings about the best returns. Personally, I prefer to maintain more autonomy over my investment plan instead of just blindly throwing in my money at fixed regular intervals of time, totally ignoring whether the securities are currently fairly valued or not. Understanding the valuation of a stock is also very important. And that's because you do not want to end up in a situation in which you buy the stocks which are overpriced, as there is a likelihood that the stock prices may tumble down anytime. Personally, I strongly believe in performing both fundamental and technical analysis. So technical analysis meaning that to perform analyzing of the stock chart patterns and candlesticks to enter the market at the right price. Instead of adopting the dollar cost averaging strategy, I prefer to use the dollar value averaging strategy. Dollar value averaging strategy is a strategy in which you invest your money by buying more positions when the share prices drops and buying fewer positions when the share prices increase. How many times have you bought a stock thinking that you have gotten it at a perfect price, only to see that the stock prices decrease just weeks or months after that? Do you think to yourself at that time, I should have waited a little longer? With dollar value averaging, you will then be able to capitalize on the temporary price corrections by adding positions at different points in time at different price levels. You have full autonomy to decide on how you want to apportion your capital to enter at different price points, instead of sticking to a rigid plan of putting in a fixed amount of money at regular intervals of time. In addition, it reduces the impact of a price drop to your portfolio as you're adding more positions alongside the decline in prices. Some new investors may also be scared off by the temporary decrease in the share prices and their paper losses, only to sell off their positions and crystallizing the paper losses into actual losses. Let's take a look at SPY ETF to understand this further. If you look at the prices at the start of July 2019, I would not have entered a position as the prices were at all-time high at that time. If I had been disciplined and patient, I would be able to add some positions at a lower price when there was a price correction in August 2019 using the dollar value averaging approach. Advocates for dollar cost averaging strategy would usually oppose to the idea of using lump sum investing strategy. But I personally do not condemn lump sum investing strategy, as I find that it's a matter of time and situation in which we apply the best strategy. Looking back at the SPY ETF price chart, I would have either used the lump sum investing strategy or the dollar value averaging approach to enter positions when the price crashed to its lowest in end March 2020 to early April 2020, because prices have already declined by a considerable amount from its usual level. Having said that, you must first ensure that you have first done your due diligence in picking only the good stocks to invest in. Do not fall into value traps. And in Singapore, the SPH stock is one good example. It has been on a downtrend since 2015. Imagine what would have happened to your portfolio if you have been doing dollar cost averaging since 2015. We hope you have gained some meaningful insights through our sharing on dollar cost averaging and dollar value averaging strategy. I would not say that dollar cost averaging is a totally bad strategy. In fact, I find that it is a rather good strategy for people who require a more disciplined approach in order to get them started on investing. Because after all, it is better to get started on investing than not starting at all or just giving up halfway through your investment journey. But personally, I still prefer to use the dollar value averaging strategy and sometimes even the lump sum approach, depending on the situation on which strategy is the most appropriate strategy to use. And before I end off this video, I hope you can take away this tip with you. And that is, dollar value averaging is just an icing to the cake. That means to say, even if today you adopt a lump sum investing strategy to purchase stocks of a fundamentally strong company at a good price, you will still see good returns over the long term. Thank you for watching this video. Remember to hit the like and subscribe button. I'll see you in my next video.